Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Saugata Bhattacharya, Chief Economist at Axis Bank, joining in. Saugata, welcome to the show. Always a pleasure to have you and speak to you.
Always a
Saugata,
privilege to be with you, Hiral. I mean, in your show. I mean, always.
thank you so much. Saugata, my first question is: has the budget been in line with what you were expecting? And would you say that it does aim to provide a booster dose for growth with an accommodative fiscal stance?
The budget was much, much better than we had expected. But I mean, this is the budget that we had actually been advocating. So we had expected the government to follow their previous stance that they had shown a preference for fiscal rectitude, fiscal prudence, etc. But this time, quite certainly, I mean, realizing the gravity of the economic loss, the economic impact from the COVID crisis, they have very wisely, in my opinion, done two things. One, increase spending, and secondly, I mean, we layered that with a whole bunch of other proposals that are designed to improve sentiment, confidence, which is one of the key things that is now needed to get India to a 7% growth. So obviously, I mean, from the FY20 levels, FY21 spends have increased almost by 8 lakh crores. Some part of this actually being capital spends, which has been the other way around in the previous years. So revenue spends have been increasing. This time it's capital spends. Of course, I mean that's still a small part of the overall expenditure, but capital spends have increased. And the focus emphasis on infrastructure, manufacturing, etc. That also shows that there is an intent to start improving productivity for Indian manufacturing, Indian service activity as well through infrastructure, better infrastructure. And lastly, the series of measures to improve sentiment, the taxpayer measure, the ability to open the tax case by halving that from 6 years to 3 years, etc. Plus a whole bunch of other, I mean, ease of filing taxes, etc. Is designed to lower the level of uncertainty, as Finance Minister herself said. So, I mean, these are just some pillars. I mean, all of these have been layered surrounded by a whole bunch of other activities. Of course, I mean, the critical question is now implementation. So let's see how they plan to take this forward.
Absolutely. Implementation and execution is going to be key from here on. But other question I want to take with you is with regards to where the nominal GDP growth projection of 14.4% is concerned for FY22. Do you think it could turn out to be an understatement, taking into consideration if growth comes back riding on the, spending prowess, and overall it could provide the government a room for higher spending then?
So I think, and that's one of the other highlights of this budget that's important. I mean, the how realistic the assumptions seem to be, even an understatement. So let's break this up into a few parts. So that 14%, 14, exactly as your sense is that this might be an understatement. People say that, of course, I mean, there are the risks of a renewed wave of infections coming in, further closures, further restrictions, etc. So it's good to start with a lower base. But remember that even a small, I mean, compared to the 2020 levels last year, March 20, not this year, from March 20 levels, if the economy were to go up even say 3% or 4% more than the levels that we had seen in March 20, that itself will take the sequential the year-on-year growth rate to about 13.5%. Our estimate of inflation is about 4.5% for the next year, maybe a little higher. So that immediately has the potential to take the entire growth rate up to 18, 17 and a half, 18%. So I think there's that exactly as you say. There's the scope for actually expanding your basis. Now, the second question is the buoyancy that they have taken in terms of the individual taxes. That on the face of it looks to be a little high, 20, 22% for GST, for corporate taxes, direct taxes, etc. But I think overall, I think with economic recovery happening, I mean, more service-oriented industries coming back in line, etc. There is the chance they might fall a little bit short here and there with increased tax compliance using data analytics, etc., which finance minister and the finance secretary mentioned. There is the scope of coming close. That part is important because otherwise the significantly large borrowing program might actually need to expand. But I believe some part of that, even if they can't meet the tax revenues, some part of that can be made up with all the disinvestment, land monetization, asset monetization programs, etc. But ideally, there should be an effort to increase tax revenues in themselves.
Right. Saugata, what do you make of the fiscal deficit number at 9.5 in FY21 and then a 6.8 in FY22? This is the first time ever I think everyone's talking about that the government has been open to give out such an expansionary number.
So this we heard this from the expenditure secretary that once the government had decided to breach the fiscal FRBM, the Fiscal Responsibility and Budget Management Act, the restrictions, the ceilings in the budget, then the next logical step was, since we have already breached this, might as well then go the full way and then use this to clean up our balance sheets. So you would know that in the 9.5% FY21 budget deficit, the revised estimate of the budget deficit, about 1.5% of that is bringing the old FCI loans that had been taken as an off-balance sheet item into the balance sheet, so directly onto the government's books. So you bring that back into the books. Obviously, from there, from 9.5 to 6.8, and then over the next 4 years to 4.5, will require a lot of effort. So there's no doubt about that. The asset monetization program that we were talking about will be a very key component. But I think as a result of which, so markets had initially bond markets had initially reacted a bit negatively. But again, I mean, it's beginning to come back into line. I think there was a need now this year. This year, FY21 and FY22, given the kind of scarring in employment, given the loss of MSME and smaller companies, the incomes of smaller companies, there was a need to counteract that with government spending. This has been, and credit rating agencies, which have always been a constraint on higher spending, I think there is now this emerging global fiscal consensus of the need for higher fiscal stimulus. You've seen that in the US, in the UK, in the EU. EU is somewhat more restrained, but across countries and geographies, governments have actually responded with higher stimulus programs. So it will be very difficult for the credit rating agencies to push back against this view. And actually, one of the credit rating agencies has talked positively on this view of boosting growth, because boosting growth, as the economic survey also said, the counter-cyclical measures by higher spending is one of the way of sustaining growth, and the higher sustained growth in itself serve to bring down the fiscal deficits, the ratios of the fiscal deficits in the years going forward.
Right. So with this, if you talk about the borrowing number as well, it's higher than expected in FY21. If you take the FY22 consensus borrowing estimates as well, it's higher than that as well. Now, the day the budget was announced and the day after that, there was some pressure that did come in terms of where bond deals go. What's your expectation from here on? Do you think, how will the 10-year yields react from here on? And do you think some bit of RBI support is something that will be required then?
I mean, more than consensus, we are going with the government's own estimate of a gross borrowing program, center government borrowing program of 12 lakh crores. And you will also have state government borrowings of anywhere between, likely state government borrowings of anywhere between 10 to 10.5 lakh crores. It's a significant number. There's no doubt about that. But for one part, this will need RBI support, which we will see tomorrow in the MPC and then the governor's statement in what. It's going to be a difficult issue. I mean, this needs to be managed very adroitly. For one thing, banks will not be able to support the government program like it had done in FY21, because for the first half at least, there was almost no credit growth. So banks could afford to invest the higher deposits that were coming into SLR instruments, SLR securities, government bonds, state government bonds. Next year, hopefully, there will be some credit growth. So you will probably not banks will not be able to support as much. So this will require Government of India, RBI support to the Government of India program via higher OMOs, etc. But they also are a little bit constrained because by doing this and the expected capital flows, they are likely to increase the levels of liquidity, surplus liquidity in the system, which is probably something that they will want to not to be doing, or they will need to absorb that liquidity, the higher liquidity in the system. One way out, of course, and we are hearing that there is some discussion in the government, is to get India included in global bond indices. We are trying to do this in steps with limited set of securities being, etc. So that would help a lot. I mean, by diversifying the base of global investors in Indian government securities, yeah, by allowing FPIs greater access into India, I think that will help to reduce the pressure on yields going forward. Having said this, I think yields over the course of FY22 are likely to rise somewhat from the current 610, 612 levels, maybe to 620, 630, somewhere in that range, maybe a little bit higher. But I think that's something that we can live with for in a year where spending needs to take priority.
Right. So when we're asking, talking of spending, which needs to take a priority from here on, do you think the budget has actually laid the foundation for, say, lifting the Indian economy from the under $3 trillion to a $5 trillion economy from here on?
I think that you're absolutely right. That I mean, this as we discussed with your first question, that the series of measures. So not just from an economic growth standpoint, you need to be very worried about employment, jobs. So it has to be growth and with creating a lot of jobs associated with it. So one of the things, I mean, there is a supply component, as you discussed. I mean, the emphasis on infrastructure or manufacturing, etc. So that should tend to push out. But there's also a demand component in the budget. I mean, coming in, say, from the measures for textiles, on affordable housing with long backward and forward linkages with construction, etc. That can provide jobs. Textiles is another job creating segment. As the services segment opens up, I mean, you will presumably be able to draw some part of the displaced labor back into the health, tourism, hospitality sectors. Health becomes very, very important to my mind because the focus on health that's been given. You just imagine the potential. I mean, given the shortfalls, shortcomings that we have seen in the healthcare infrastructure in this COVID environment, that if we were to go for a more longer term measure, I mean, the ability of healthcare systems by way of secondary, tertiary healthcare and medical workers in smaller towns and villages, etc., to be able to absorb with a little bit of retraining, the ability to absorb them, the surplus labor from the agricultural and the small towns into the segment has enormous potential. So I think a little bit of imaginative look at employment will set the stage, other than all the supply bottlenecks, logistics parts that the government is trying to deal with, all the railway dedicated freight corridors, etc., ability to do things faster. For India to become gradually go up to the 7%, 7.5% potential growth that will be necessary to get India into that quickly get India into that $5 trillion economy mark target.
Absolutely. The enhanced capex for infra and manufacturing sectors is something which would probably generate overall demand and drive employment generation. But with this, Saugata, another important aspect is how the FIs react to the budget. Do you think that the monetization of infra assets, the divestment plans, and the conducive tax compliances are they enough to attract the much needed foreign capital into the country right now?
Well, enough is a enough is a very broad definition. So but you've already seen the amount of FPI flows that have come into equity. There's been a sell-off in the bond markets, but once things begin to stabilize, remember the global capital pool is going to be very, very richly funded throughout the next couple of years. I do not think the Fed will begin to taper its balance sheets till way to the end of 2021. So you will have access to this global capital pool. The European Central Bank is going to be with its easy monetary policy, negative rate policy for a long, long time. So with this global pool looking to returns and India whatever, it might be an artifact of the slowdown this year in FY21. But we will be growing at a relatively significant pace beyond the other countries' growth. And opportunities, as you've seen in equity markets, I mean, equity markets looking for the profits of companies, I think that's a sufficiently high incentive to bring in money into equities. On top of which, I mean, if they can design the InvITs and the REIT structure in a way that can generate, I mean, you've heard all the power transmission lines, renewable projects, logistics, Concur, the roads projects of NHAI, etc. If these can be done in a manner which sounds attractive to investors, there'll be a huge amount of money that will be waiting to coming, both from the FPI route as well as more FDI type instruments, FDI type investments into some of these asset monetization vehicles that hopefully will be structured soon.
Right. Now, with this, as we know that the focus has been healthcare, the focus has been infrastructure. However, rural and agri spends have seen a mild decline. Do you see a concern or a worry on that front? Because clearly the spending, if you see in terms of Manrega as well, that is expected to fall in FY22.
Well, rural spends were close to FY21. FY21, of course, was an extraordinary year. I mean, initially, I mean, with the money that was spent on Manrega, the direct cash transfer programs into rural bank accounts, Chandan accounts, etc. So that was you tend to expect that there would be a migration out of rural areas back into the urban hospitality services once they begin to open up, etc. So the need for spending on rural segments which actually be limited. There are also, I mean, we still haven't seen how much of the capex spends are planned to be spent in the rural areas with rural irrigation projects, drinking water projects, the Gram Sadak Yojana projects, all of that. So some part of that will also compensate. And the best way to get transfers out, Hiral, I think is still capex led rather than giving. So if Manrega can be used to create local assets in terms of water drainage systems, irrigation, micro irrigation systems, etc. All that's all to the good. But I believe it was wise to try to divert some part of the money out from the rural areas, following the tracks of the migrants who will be coming back into semi-urban urban areas, to get the expenditures to move together with the migrants, the reverse migration coming back into the semi-urban and urban areas.
Right. And overall, do you think, Saugata, that the government is using this opportunity in times of crisis to clean up its balance sheet? Because a large part of the additional revenue expenditure in FY21 is on account of the government's desire to clean up the balance sheet, clean up the FCI dues to the National Small Savings Fund. And do you think that the government is paring its off-budget funding of the fiscal deficit?
Sorry, there's a clear intent. There's a clear intent, which I began with in the beginning. That, I mean, if you're actually breaching the fiscal deficit target, might as well use this to lower the actual spends. So there's no doubt. So, and together with this, there's also some part of the spending from the central public sector undertakings, the CPSE EBRs, the extra budgetary resources. Even that's been cut down a little bit. Even some part of that's been taken onto that is capex spend. The CPSE EBRs are considered capital expenditures. So some part of the CPSE has been brought on to the balance sheet as well. So other than the revenue items from the food subsidy items that's been taken on directly onto the budget. So there is an attempt to clear out. I mean, which was obviously the one patent intent to make things more transparent. Although, I mean, transparency means you and I both knew where to look for in the budgets for the various things. But generally, as a more general signal to the government, signal to investors, etc., that this time you know the numbers are there on the table in front of you. So and better to reduce uncertainty, put forward your investment decisions, etc. I think that's a good step and something that everybody had been pretty much asking for a long time.
Right. And again, on the revenue front, see, the tax projections are looking pretty much reasonable. Yeah, probably FY21 could see an upside surprise given that the government's conservative estimates. However, if you see on the other front, say if you're talking from the divestment target, do you think it's ambitious enough? Or do you think this is something which will be difficult for them to achieve?
I somehow, I mean, it looks a little bit on the higher side, but if you add in the LIC IPO, if that actually goes through, the actual collections will be much, much higher than the 1.7, 1.75 lakh crore target that you've seen. Because this includes the pipeline for FY20 that will be added on into FY22, FY21, I'm sorry, that'll be added on to FY22, all the remaining, the BPCLs, the Concors, etc. And finally, at the end of the day, if the equity markets hold up, and there is reason to believe that globally, in line with global, the equity markets will not come down very sharply. So valuations will be relatively high. So things like SUTI stakes, things like an equity market ETF, for instance, I mean, all of those can be used if something somehow revenues actually fall short from the target. Those can be used to top up the actual sales of assets. More than the sales, I think the signal that is coming in from the proposed sale of two public sector banks and one general insurance company, I think that signal, if they can follow through with that, these are not expected to be huge revenue earners. I mean, you're not going to get huge valuations for these companies, for these banks and insurance companies. But just the signal that we are willing to look at new ways of, I mean, look at privatization in a sensitive sector first, and new ways of raising resources, new entities, etc. I think that itself is a signal that more investment, we are open. We are looking for foreign investment for the global capital pools. And I think the investors will be very recipient to these signals.
Right. And Saugata, moving from the macro front, if you have to talk about the financials as well. Now, the thrust that the budget has given on infrastructure, do you think that's something which is going to be positive for corporate credit growth? Because again, credit growth has been a concern for quite some time right now, taking the pandemic into consideration. And now that we're looking to set up a development finance institution, do you think we will be able to enable and catalyze infrastructure financing from a positive point of view?
Yes, I mean, look, banks by themselves will not probably have funded new infrastructure. I mean, there are, I mean, quite apart from the somewhat adverse experience for the last infrastructure credit cycle, there are questions of asset liability mismatches. Banks deposits largely have a 2.5 year maturity on average, and the infrastructure project liabilities are 6, 7, 8, 10 years in line. So, I mean, the RBI Basel restrictions do not permit that kind of ALM. So, banks would not have been able to take on the kind of public-private sector financing risks that had happened earlier. Not possible. So the basic play is to get, I mean, the DFI itself there's some funding, seed funding by the government, but more than that, to leverage other private sector, longer term private sector investments. I mean, the natural home for infrastructure financing are insurance companies, pension funds, etc. To be able to manage the funds and also attract leverage overseas, long-term overseas capital into these projects. But banks have an opportunity because banks will not be lending to the projects themselves, but the project work is done by a series of contracts. So, I mean, the developer, the promoter gives it to the first subcontractor, who then gives it to the second subcontractor, etc. They're down a long way. And banks will be happy to take on EPC funding so long as the flows, the funding flows to the EPC contractors are assured. Banks will be very happy to participate in the EPC funding, which you have seen in road projects as well. Either a HAM type project, a hybrid annuity model project, or an EPC, direct EPC model. Banks will be happy because this is the initial phase, the construction phase of the projects. The next big play in infrastructure financing will be to get the either the securitization via InvITs, etc. And banks can also participate in InvITs now. There are some issues that need to be sorted out, but banks have also funded some InvITs going forward. So banks have a play in infrastructure financing, but not at the top level of the projects themselves.
Right. And overall, for the banking system as a whole, how big a positive will the bad bank be? Because now that the government has announced setting up of an ARC or AMC that would consolidate and take over the existing stressed debts, do you think it will actually help banks release a significant bandwidth and enable them to focus mainly on growth opportunities from here on? Because a bad bank has been in the offing for quite some time.
So again, from the bad bank, I think the best part of this suggestion is that the bad bank will not be funded by the government. It will be so we are all waiting to understand the details of the operational structures of this, either the DFI or the asset reconstruction, the asset management companies, to see how these institutions are structured, what are the operational details of these institutions. So the broad top level understanding is that the government will not be investing. I think that in itself takes care of some moral hazard. The other contrary way of looking at this is that there is the IBC, the Insolvency and Bankruptcy Code, that is already operational. So why do you not use them for faster resolution of the assets? So remember, this is largely for the public sector space. I mean, particularly the nationalized banks, not so much for SBI, for the nationalized bank space. So there are multiple issues there. I mean, and the primary issue is, of course, valuation of the handover. I mean, what is the haircut? What is the loss? What is the price that public sector banks will sell to the proposed ARC, the AMC and the ARC? So what is the price? So those have implications not only for the oversight from the statutory authorities. I mean, the CAG, for instance. I mean, the questioning the assets, the valuation of the assets. But banks will also have to lay aside capital. So, I mean, if you take a haircut, if an asset is 100 rupees, you take a haircut of 30 rupees. That 30 rupees, otherwise, banks would have to provide for provisioning of that loss, of that haircut over a period of 4 or 5 years. Once you sell that asset off and write it off in your books, you have to provide capital immediately. So that would mean a further degree of capitalization over and above the 20,000 growth capital that the center has given the public sector banks. So those are issues that need to be sorted out. What kind of regulatory forbearance, etc.
Correct.
So we are all awaiting the operational details, but there is a case for setting up the asset reconstruction.
Absolutely. And very lastly, Saugata, if you talk about the RBI as well, they've done enough in 2020 already, because I think the way they acted with regards to rate cuts or providing liquidity was fantastic. 115 basis point rate cut since March 2020. They have continued to remain accommodative as well. And if you see with regards to the systemic liquidity in FY21, that's remained in surplus so far. So if you have to talk about the next RBI policy as well, what is your expectation and how are you expecting them to act?
So for starting from this, the response from Governor Das and his RBI team has been absolutely out of the world. I mean, this kind of progressive, dynamic, proactive response is very rarely seen. So my compliments to that response. That has helped stabilize. I like to think of this in the context of what I call a survive, revive, and thrive cycle. So RBI's actions during the initial lockdown survival phase, that was, and then moving over into the revival phase as well, recognizing the asset stress in the system, the regulatory forbearances, the relaxations in microprudential norms, all of that. So, but as you say, beyond a certain point, this kind of liquidity, all the others, some of these measures will start getting rolled back. Some of the regulatory, the forbearances that have been given are pretty much now coming to their close. So this will inevitably lead to some more manifest asset stress in the system. So NPAs are likely to increase, etc. So that all of that will happen. So that's one dimension through which RBI will have to manage the system. RBI Financial Stability Report talks of this. The second part is liquidity, because probably this level of liquidity will begin to have an overall negative effect once the recovery starts in. It has the potential for feeding inflation, although that's not so much a worry. More than that, again, some kind of financial stress that emerges from the system through reckless credit growth, etc. So all of that. We are a much more mature system now after the experience of the last 2 or 3 years. We are a much more mature, more regulated, better monitored system. So the implications will be lower. But at some point, I do not think tomorrow they will even talk of easing on the accommodative policy. So that will remain for the next quarter or a couple of quarters. But at some point during the course of FY22, they will have to, RBI and MPC will have to start thinking about ways of communicating a way of draining the liquidity out of the system without causing undue financial disruption. Yield should not go up to 696, 710, given the magnitude of the borrowing program, etc. So that is something which is, and this is a really difficult task for RBI. But having seen their actions and seeing their ability to manage, I'm relatively confident that they will be able to pull it off in a graded, gradual, baby step pattern going forward.
Right. And very lastly, inflation also becomes a critical component that we need to watch out for. How are you expecting the inflation numbers to pan out from here on?
So in the immediate future for Q1, January to March, our forecast is about a average 5%. I mean, you'll get a very low inflation print for January, then moving up because of the base effect, so 5% average. Then we are factoring in about a 4.5%, as we discussed earlier, 4.5% inflation, CPI headline inflation, averaging for FY22. But there are clear risks. One is crude prices. Global commodities analysts are expecting crude prices to average around about $60 a barrel. Brent crude prices to be $60 a barrel. This is up from $43 a barrel average for 2020. So that's one clear risk. The second risk is industrial commodities prices. Because as global recovery, as the vaccine spreads, as global recovery keeps pace, increases pace, there will be higher demand particularly from China in industrial metals. I mean, so you've already seen the way that copper, aluminum, and a whole host of other automotive-related metals, iron ore, have gone up. Agricultural prices too have increased. I mean, it's not is a significant possibility. But again, and that will further complicate the effort to normalize the process as inflation goes forward. But that will need to be managed. That will need to be closely monitored. And obviously, I mean, government efforts to tweak many of the excise and customs duties at significant points of inflections in the inflation rate. That will also add to overall monetary policy efforts to curb inflation.
Absolutely. Thank you, Saugata, so much for joining us on the show. Pleasure speaking to you. I think great insights, and let's see how the policy also plans out. And I hope that execution is something which remains on track, and we see things picking up from here on. Thank you so much.
Thank you so much. Thank you so much, Hiral. Pleasure to be with you as always. Thank you so much for having me on the show.